Okay, class, welcome back after break. Okay, remember today is the last date of our assignment, number 1. So I gave you this assignment, question number 1, 2, 3, 5, 9, 10, 14, and 15. Okay, our today's target after the break, we are now covering chapter 3, in which we talk about foreign exchange market, international money market, international credit market, international bond market, and international stock market. Now, first of all, let's talk about foreign exchange market. So what is foreign exchange market? It allows for the exchange of one currency for another. Exchange rate specifies the rate at which one currency can be exchanged for another. Also, the other name is called forex or price of the currency. Like 1 pen is equal to 10 yuan. So 10 yuan is the exchange price, exchange rate for 1 pen, or the price of 1 pen. So similarly, if 1 peso is equal to 10 yuan, it means the price of 1 peso is 10 yuan. And we call it exchange rate or price of the currency, right? And now let's talk about some brief history of foreign exchange. So number 1 was the gold standard, which lasted 1870 to 1913, in which each currency was convertible into gold at a specified rate. So that country which hold more gold reserve, their currency will be higher for that country which holds low reserve. So each country used gold to back its currency. It means in that era, if United States have $1 million, then at that time exactly $1 million worth of gold must be there with the central bank of US. It cannot be like that they have $1.2 million, but at the back end they have 1 million gold. In that case, they violate this gold standard agreement. So when the World War I began in 1914, the gold standard was suspended. We are not going into very much detail. For details, you can revert back to the chapter and you can just find other details as well. I'm just giving you a little know-how here because that is not the goal of this lecture. Just to know how that that in gold era, every currency is backed by gold. The second one is agreement on fixed exchange rates. So in that era, we created a system in which we meet regularly and we talk about that we are going to fix the exchange rate. For example, 1 Canadian dollar is equal to 10 US dollar, or $1 is equal to 100 Canadian dollar. That is just for example, and that will prevail until next meeting. And meeting going to be like, for example, after 3 months, 4 months, or maybe 1 year, whatsoever. So it means we fix it. So in Bretton Woods Agreement, Sir Bretton Woods, they came up with the idea, and this agreement lasts between 1944 to 1971, and it says that if there is too much demand and supply problem, then we can only allow the currency to fluctuate only 1% above and 1% below. It means the currency can only be appreciated 1% and only be depreciated 1%. Below that, nothing can happen. It is fixed. And then Smithsonian Agreement, which is after 1971 to 1973, it says we should increase this percentage to 2.25%, and the world followed that. So even then, this agreement couldn't hold, and then we came up with the new system. We call that floating exchange rate system, which means currencies are traded according with the market forces, which is demand and supply. If in the market the number of dollars had increased, which means supply of the dollar had increased, the value of the dollar will go down. If more people want to purchase dollar, it means demand of dollar increased, so the price of dollar also increased. So we let the market forces to play with our exchange rate system, and we call this floating exchange rate system. So in the world right now, we have floating exchange rate system, and we cannot say that it is fully floating exchange rate system. We can say that it is managed or with the little intervention of government as well. Okay, now let's talk about foreign exchange transactions, how these transactions can occur. So if you want to buy some foreign currency, there are 4 things that you can do. One is over-the-counter market. So over-the-counter market, it is a virtual platform, a telecommunication network, where companies normally exchange one currency for another. So these counters are less controlled. If one company needs $1 million, or you can say that less control or less standardized. So over-the-counter markets, they are less standardized. The control over there is a little bit less. If you want 1 million, or if you want 1 million and $1, you can also get the code or get the price from this virtual network as well. Second one is foreign exchange dealers. They also serve as intermediaries in the foreign exchange market, which means you can go to the dealer, you can ask that, okay, I need $1 million, can you arrange for me? And he can say that, okay, in 3 days or in 3 minutes, give me 5 minutes or 2 days, I will arrange that. So what are the income there? They charge some fees because they act as your agent, intermediaries. Number 3 is foreign exchange transaction for immediate exchange, which means spot market. If you need $1 million, you can go to spot market, the market where these transactions are actually happening over there, and for instant basis, for today's basis, and that market is called spot market. So the exchange rate in the spot market, we call that spot exchange rate or just spot rate. Spot rate at the spot. If I need $1 million, here is my currency, just give me $1 million. What is the rate right now? Give me that one. In dealers or in over-the-counter market, you can decide, I need after 3 days, I need after 6 months, I need after a year, right? But in spot market, if you need right now, rates are available, transactions are happening, buyers are there, sellers are there, they are ready to buy from you.
Sir,
yes.
But if you say like, I'm a little bit confused. If you say I need this money for 6 months, 6 months.
I need money after 6 months.
Yeah, but
not for 6 months. This is not lending. Okay, this is just buying and selling of foreign currencies.
Yeah, I understand. But what I, if you need the money in 6 months, so how can they can guarantee that the currency will be like at the same levels that now?
Okay, for that purposes, we will be learning all these techniques later on. We have chapters on that one. So they
Okay.
forecast. They have different models, right? They see countries, economy,
Right.
all the stuff. They predict that the value going to be increased or decreased. Then they give you some kind of contract rate.
Okay.
Whatever in the market, for example, after 6 months, they give you expected rate. They give you that, okay, this would be the rate. If, and after that, there is the actual rate. If the actual rate is less than the expected rate, then it is the profit of the dealer. If actual rate is less than, if actual rate is greater than the expected rate, then that is the loss of the dealer. So that is,
Okay.
we'll talk about over there. Okay.
Okay.
So number 4 is the trading between banks occurs in the intermediate market as well. So banks, if banks need money, then they have a channel we call that interbank transactions, interbank channel. They can go to and ask, for example, the HBSC, right? And we have Standard Chartered. If HBS need $1 million, they can ask directly the Standard Chartered to give them money. So Standard Chartered will immediately will send some money with very minimal rate, because they know that at the end, if Standard Chartered needs some money, they can ask from HBC as well. So there is a trust among the banks, and also the banking relationships among them are very good. So why to go to the market and ask others from these for money? If we have already established network, we can ask quotations, or we can ask this kind of money from our interbank platform, and that market is called interbank market. Only banks are eligible to join that market, not individuals like me. Okay, so let's share
Sir,
some.
I'm just curious.
Yes.
Out of curiosity, the interbank market,
Mhm.
how much different are the rates and the preparation periods there in comparison to other markets?
Okay, so at the end of every day, all the banks money will go to treasury, right?
Mm-hmm. Yeah,
Because bankings have different branches, right?
yeah.
This is, for example, bank A. These are the bank A branches, and this is the treasury of bank A. So at the end of the day, all the money is shifted to bank's treasury, right? And this is A bank, for example, this is B bank. This is treasury for B bank. Similarly, they have different branches. Now, what happened? People come here to save money, to deposit money. One person came here to bank B and deposit 10 million. And your treasury is in the capital, country capital. So transferring this $10 million over the night, 4,000 kilometers, it's really hard. You agree with me? Right? David?
Yeah. Yes, yes,
Okay.
yes.
So what if, but since the $10 million, this branch cannot handle